Right, let me just check on some. Yeah, it has not. Hi there, Ashish. We are just about to start in about a couple of minutes time. I'm just about to start anyway. I've clicked on the recording button already, so I think uh, I'm better off starting just now. So I would like to welcome you guys. Sorry to keep you guys waiting. I'm just doing a bit of a sound check first, just to make sure everything's okay for you guys who've just arrived. I just would like to know that you can hear me loud and clear. If you can, type into the box, and that's how you would be communicating with me as well via the chat with questions that you may have. But I would like to leave the questions to the last, so we can what do you call that, have it full swing on the webinar, and have that uninterrupted before we answer some questions. Okay, so I would like to firstly, last but not least, to say a very good evening to you guys, and would like to welcome you guys in today's webinar organized by investing.com. I'd like to thank investing.com, and I represent Orbex. My name is Kenny Simon, and thank you guys for attending today's webinar. Now, today's webinar is titled The Avid Gold Trader. As you guys know, I'll be talking a lot about gold, just to give you a bit of a brief through, a run through with the markets, with gold situation at the moment. A lot of you guys are wondering about why gold has not actually made its bounce upwards. A couple of questions you guys may have, and we want to get that answered as well. And I would like to share with you guys on some very interesting techniques on analyzing the market using geometric patterns, which I do. So I would like to share on that based on the gold's position, gold's prices, together with the USD index and a couple of other major pairs too. Now, just before we go ahead with it, let me just run through the disclaimer here. And as you guys know already, any opinions, news, research, analysis, prices, or any other information that I'm sharing with you guys today, or what I say and what I present to you via the presentation slides, is provided as general market commentary and does not constitute of investment advice. Okay, so myself, my name, Kenny Simon, as a presenter today, as well as Orbex Limited, will not accept liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from use of or reliance on the information I have shared with you today. So like any other lines on the disclaimer risk, as you guys know as well, trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. So the high degree of leverage can work against you as well as for you. Now, before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. So that's me on the risk disclaimer, guys, and we shall then get on. This is myself, Kenny Simon, and I'm the head of education with Orbex. I'm a trader and trainer for more than 8 years. Trading methodology-wise, I'm very much into price action. I specialize in a couple of instruments, but more into a couple of instruments. I specialize in geometric patterns, price patterns basically, and we've also got the price trade plan that I have sort of formulated in order for me to teach the geometric patterns better with combination, in combining with technical and fundamental analysis. So I like to go by bank reports, but specific cherry-picked bank reports to understand unusual activities mainly, and I usually like to combine that with what I see on the chart, especially patterns. Okay, so there you go. I like the balanced approach of trading, fundamentals, technicals, understanding psychology as well, and a couple of other effective and essential elements to trading. Okay, guys, so here you go. We'll talk a little bit about gold before we, the yesteryears of gold. We would like to go into understanding first. Before we go into gold, we need to understand that there are differences between currencies and money. And as you guys may have read or heard about how the dollar bill as you guys hold it today may be very different from what it was years ago. I mean, before 1970, we've got a orange type stamped onto the dollar bill. So now the dollar bill is said to have reduced its value by 90%. Okay, so it's close to toilet paper value, as they say. Okay, a lot of people are talking about it nowadays and wondering whether or not that's true. Now, if you go back to history, you will understand that the orange stamp that I've talked about, due to the Bretton Woods time, would allow you to exchange your dollar bill with the equivalent amount of gold. Okay, so there's it's backed by something, and it was backed by gold. So you have got the difference between money and currency. And currencies nowadays may be different compared to money, mainly because it's not backed up by anything, and it's called fiat currency. This is the four-letter word that is designed to reduce the currency value. Okay, so fiat currencies are designed to have their value decreased, and hence the reason at this moment of time you're hearing a lot about reducing rates, and you hear about NIRP, you hear about negative interest rate policies and things like that. Now, the negative interest rate policy, if I may share my opinion, and from quite a number of people would agree on this, experts agreeing on this, is it benefits the government. It would actually be of big help to central banks to have the reserve gold, especially, to be higher in value when you have negative interest rate. So if your interest rate, see, gold is zero, let's say, yeah, it's got no rate. So if gold is zero, then you've got your currency interest rate just goes into the negative zone. What would then happen is you've got your gold valued higher than the currency. So fiat currencies, currency, yes, it's compared to money, not backed by anything, and they are designed to lose their value. Okay, but you've got all this insiders game by central bankers, policymakers, and all that to have that designed in such a way to benefit the governments and to benefit central banks so that they can actually use the gold to hedge. Hence the reason we have got records of, news and all that talking about accumulation of gold. So we've got accumulation of gold by some superpowers, including the States, of course, but one that has got the highest track record of buying, purchasing gold over the years is China. So China has been known to actually have recorded or given the numbers as 1,500 plus tons of gold, but this 1,500 tons of gold may not be real. So we've got evidence, some evidence. I mean, they're speaking louder than words are the numbers showing that you've got close to 5,000 tons accumulated by China, and China is said to have an aim or a goal to reach the 8,000 tons mark, and once they have that or achieve that level, they would be the main or power decision makers in deciding the price of world gold. Okay, so that may be a reason why they're accumulating so much gold. And we have also got quite a number of news indicating the interest of China swapping their yuan with Swiss francs, and then coincidentally we've got highest buyers of gold in Switzerland are the Chinese. So they've got quite a number of activities revolving gold buying and purchasing. That also includes the States, we've got Malaysia, Jordan, Singapore. These are countries that have actually recorded quite a high activity in purchasing gold. Okay, we're talking about physical gold, and quite a number of you guys are wondering about the nature of economic cycles, wondering about why gold is just plunging at the moment as opposed to what people are talking or expecting for prices of gold to increase. Now that has a lot to do with the number, the amount of paper gold as opposed to physical gold. So we've just got loads of paper gold and we've just got perhaps not enough physical gold. Okay. Now the nature of economic cycles, I mean, when we talk about monetary policy has been known to have changed every 30 to 40 years. So we are now in the 35th year of that, and we're quite close to a monetary change, possibly or probably. And that has been more evident of that is due to what's been happening. I mean, with Brexit, one of the biggest news revolving that in the world is the Brexit, and then now we've got a new president as well at play. So that does coincide with the possibility of that cycle happening. Okay, then we've got manias and panics and things like that, and this is part of that cycle. And we've got bubble brewing as well, and the bond and derivatives market bubble is set to burst, and it's getting bigger, and that's what mainly it's talked about. And within all these cycles, manias and panics, also with the impact to the global economy, we've got geopolitical factors as well, and all these ones are just making gold even more attractive. And hence the reason I have chosen to talk a lot about that, and we've talked a little bit about NIRP, inflation. Inflation targets amongst countries are basically at that level there, 2%. Okay, so reducing the rates and all that would benefit, as I've mentioned earlier on, to just increase the reserve gold value. Okay, so that is actually quite a play by governments as well to reduce and then decrease, but then the major play would actually be has got a lot to do with gold. Okay, I mean we may have not realized this a lot. I mean we know gold not only as jewelry, as good investment power for us to accumulate, but what's playing behind the curtain nowadays when it comes to geopolitical reasons, political as well, is that gold is used to hedge treasury bills, treasuries that they've owned. So this has got a lot to do with how China, for example, is absorbing U.S. debt by buying U.S. treasuries. Okay, so that absorption of it would then give more play between the U.S. and China in giving or not giving, but to close an eye to manipulations of prices, whether it's gold or other precious metal. But we're talking about gold specifically due to its position in the market today. Okay, so this is basically something that we would need to just understand. The early warning signs. EWS stands for early warning signs of a financial collapse. Okay, we would need to understand, for example, the position of gold has got a lot to do with which level, which position the country is in, whether it's inflationary or deflationary. But in both instances, because gold is always consistent, gold is also an insurance, so that would then give gold its value no matter whichever status that it's in economically, whether it's inflationary or deflationary. Okay, so you've got inflation, deflation, market collapse, and financial warfare. Now these are what we would need to just grasp or get a hint of what's happening either globally or within a country. And usually you've got the countries going through these cycles, okay? Inflation, deflation, market collapse, financial warfare. When we talk about financial warfare, we're talking about currency wars as well. And currency war, very simply, has got to do with what I've just mentioned about reducing the rate of the currency. So you've got one country, you know, really battling it and reducing its rates, its interest rates, making its value really low. And this is what we're going through at this moment of time. I mean, in this global world, we're looking into loads of hints through negative interest rate policies and all that, and that has a lot to do with what they are trying to do with balancing their own books internally, and that has got a lot to do with the purchasing of gold that they don't talk a lot about, but having that as a reserve, and also hedging, using gold as a hedging tool for treasuries. Okay, so this is these are keywords that are important for us to know, and these are major war themes in 2016. You may have heard about it, but currency war, trade war, and world war. And now we've also got Trump elected as the new president, and as we know, we've got loads of hints about how he's dealing with the TPP, Trans-Pacific trade, and this is really something really big to know about how he is going to be attracting investors. I mean, investors mentality at the moment, they have got in their minds, you've got a couple of years of good economy after Trump's election. So, I mean, having Trump being elected, this is what investors have in mind, and this is a norm or a mass psychology of trading behavior or the financial behavior. So this is why we're looking into a rise in the dollar as opposed to a fall at this moment of time, and we've got more of that expected for the dollar to go up more. And this is a chart here on gold prices, and let me just move this tool right there. We've got, just to give you an idea of a 100-year historical chart here for gold prices. As you can see, you've got the year 2016 right at the end here, somewhere here, and this is just to give you a bit of an illustration. This is gold prices per ounce from 1915. Okay, 1915, and of course it's deflated using the headline of the CPI, Consumer Price Index. The current month is updated on an hourly basis, as you can see, and the current price of gold is today, as of 29th of November. This is the price here on average, 1,190.80 per ounce. Okay, and this is just an illustration giving you an idea of how the rise have had happened. Okay, and you've got how it has actually started with the price right there, and as you can see, you've got higher highs and you've got more higher lows as well, for those of you who are familiar with technicalities. And then you could see that it's making that rise upwards, and that trend itself, that angle that it's trending towards is quite steep, and it's only giving more hint to the upside just based on that. I mean, we're just talking about visual, okay, just visually of what we can see based on the gold prices. It's a historical chart basically. Okay, so if I move on to just a second. Okay. All right. Then we've got the gold to oil ratio as well here, and this is the this chart itself tracks the ratio of price of gold per ounce over the price of oil per barrel. Okay, it basically tells you how many barrels of oil you can buy with 1 ounce of gold. Okay, so this is giving you a bit of an idea. I'm just sharing with you charts on current positioning of gold, and then we go on to some fundamentals, talking about news of current situation for gold, and then from there on we'll go into more technical and then geometric patterns and things like that. Okay, so hi there, Leonardo. Yes, we can have that arranged. It is recorded, that's right, and you'll just need to make contact, via email to Orbex. You can simply email us there, or go on to the chat at Orbex and request for the video. Okay, it is recorded, definitely. Okay, guys. All right, so this gives you a bit of an idea as well. I mean, just gold to oil ratio. This again has got, as you can see, the movement there as of now. It's quite steep. When I say now, this recent years, basically from that 2010 onwards there, as you can see, you've got very steep movement upwards, and that again is giving us hints to the value, being an appreciative value as opposed to depreciating. Okay, so that's another hint there, and let me just click onto that again. So let me go back. Right, go to ratio, and we have got this here. Now this is something I would like to share with you guys. Excuse me. We've got more to share with you on the on technical charts, and then we'll go and we'll go on to analyzing the chart a little bit more. But here we're talking about the USD index. For you guys who are new to the US dollar index, it's a measurement tool and an index that is comparing the dollar to 6 other currencies, so a basket of 6 currencies. Okay, and here, as you can see in the box itself, there it says a 30-year upside breakout. It's a dire warning for the US dollar, which may well continue to rise. So here we're looking into the USD index. I'll share with you with the current chart for the USD index, so that we get a bit of an idea to correlate it negatively with the dollar, with the gold. Okay, so that's highly essential. For those of you guys quite familiar with technical analysis, you could easily see that on how the blue area, that blue line, basically a trend line cuts across, and then we've got more appreciation of the US dollar index. So that gives us a bit of a hint that we should not get overly excited in buying of gold at this moment of time, as we're, some of you guys, of course, have questioned, has sent me questions about other sites and warning on the crash of the dollar and buying the gold and physical gold, and a lot of news and sites are talking about that. It's a matter of timing. It is actually important for us to understand in stages as of now what's going on. And what's going on now, if we're looking into the USD index itself, as you can see on the chart here, is giving us some hints of more appreciative value for the dollar. So it is still not really the timing for us to be buying gold or entering excitedly. Of course, for those of you guys who would like to enter early, and you've got your own plans and strategy behind that, that's okay. But as we would like to gain more information and understand first the dollar, okay, because it's not a matter of gold going up or down. It is actually has got a lot to do with the dollar's position, and it has a lot to do with what's going on, because from just economical standpoint, now we're looking at a shift to geopolitical standpoint. That geopolitical side of things need not be discarded. Okay, it is important for us to pay a bit more attention and know a little bit behind the interplay of countries, between countries and their trade relations as well, and impacting the economy. And now we're talking about Trump. We want to look into what's going on with this new president. We want to know about the state of the United States itself, okay, on what's its status economically, politically, monetary policy, a couple of things, so we can then know its plans and sentiments around it or revolving it. That's important. Give me a second. Let me just look into. All right. No questions there. Okay, so this is what we do. We'll look into the US dollar index. We'll go on to the Orbex MT4 platform in a minute, and we try to get all these hints from the fundamental side. We'll marry that across with the charts, and then we'll get a bit of an idea of what's going on with gold. Okay, now here itself we have got a chart that it's from the World Gold Council, giving you some hints on net investor flows to gold. Okay, so here itself, as you can see, you've got these two arrows, red arrows on the left side of it. We've got this growth, okay, in gold ETFs demand. So it was at 36% in 2008. After the big financial crisis, as you can see, you've got a big rise to the top there, the peak area here. Okay, now here in 2016, sorry about that. In 2016, growth in gold ETFs, as you could see there, has arisen, and that is giving us that 46.6% plus. Okay, so that is giving more what you call that hints that you've got more rise ahead. And the reason I say that is that we've got that support right there. Okay, and that support is way beyond. It's above that area there when it was actually appreciating at 36+%. Okay, and we are looking at more. Of course, we've got the resistant area at the peak area and things like that, but we would need to gather more information. But this is just a visual for you to warm up with what's going on with gold within this financial crisis, whether there's a recession at the moment, deflation, whatever that is that's happening at this moment of time. We want to marry that with what had gone on in the past relatively to what may actually go on this time around in 2016, ending of 2016 and looking into the 2017 onwards. Okay, now I'd like to show you this illustration here. Now, there's a question right at the very top here. Could the fixed income versus equity flow reverse? Okay, let's put that aside with it being quite a high-end type question, let's say, and just look into the circled or that oval-like shape. It's got a name for that kind of shape, but it's not in my mind at the moment. But just look at that circular or oval-like shape there under Euro crisis. Okay, they're questioning on whether or not the taper tantrum triggered the great reversal. The questioning on this taper tantrum, would it then be mirrored here with Trump tantrum? Okay, this is the question globally amongst experts at the moment to ask whether or not we're looking into a rise, okay, in fixed income, and whether or not we could see that reflection, that big rise reflection here post-Brexit to happen here, and that could then mean that we're looking into some what do you call that, rise of the gold prices as well. So this is again something that may hint that we may be looking at an opportunity for a price for gold prices to go up. Okay, but the question is when. So this is where we're coming to. We're trying to look into what are the cause, whether it's technically or fundamentally, but we want to still look into whether or not there is a possibility or still a probability for gold's prices to go up, and hence I would like to bring you to the chart, look into the USD index once more, apply a little bit of geometric pattern techniques, and then we try to ask ourselves on the possibility, but at least we've got a bit of a time sensitive sort of tool, okay, to apply, because the question is time. Okay, you guys, I know as investors, traders as well, will be just asking about when would gold go up, when would be best for us to enter our entry for buying or long the gold. Okay, so let's see whether we get closer to the answer, or a little bit of an idea of what's going on. All right, here there are top headlines I would like to share with you guys. And we've got the first line itself reads, precious gold slides as market looks to Fed rate rise. And this is evident from the chart itself, from price of gold, where we are looking at depreciative value of gold prices, and this is what's happening at the moment. And second line reads, gold demand from investors higher than during the recession. So you see, you've got price of gold to the downside. We've got, of course, demand, high demand. But as of today, if I'm not mistaken, I've bumped into the news talking about the biggest demand globally is from India. But there's a bit of a problem at the moment with India, with purchasing of gold with black money in India. So that's quite a big problem, having India having India as one of the largest consumer, or the largest consumer globally for gold, and that is now causing the government to come up with a plan, a sort of an action plan. Now, if at all the country, being the biggest consumer, has got hints of a ban or a sort of a strict regulation of some sort, that would then start to push gold's prices up. So that has got another thing that I've not really included in these lines here, but you want to look at India. India's consumption of gold is really high. It's got some, what do you call that? It's got some factor into shaking the price of gold, or impacting or influencing the price of gold. Okay. Now, thirdly, very interesting paragraph there. The U.S. 3-month Treasury bill, T-bill, yield has begun to soar, so has gone up. And what does this mean? It is presently at nearly 5%, which is an 8-year high, as indicated. So, as history's testament, this will attract millions of international investors to the US dollar. So this paragraph is really important, giving us hints about more rise possibility of the dollar. So that does then hint us of more fall depreciation of gold. Okay, so that is where the last line reads, correspondingly the greenback should continue to rise. So we want to match all these that we hear now onto the chart, okay, shortly. So the gold and silver producers, the fourth point there, gold and silver producers made a blistering start to the year. However, the second half of the year has been a totally different story. Let's look into the different story via the picture from the charts, okay? And monetary policy still casts its shadow of the precious metals sector with the next meeting of the FOMC. So it's scheduled on the 13th and 14th of December. So let's look at what's going to happen, okay, with the FOMC. As a lot of manipulation of price of gold at the moment. As I've mentioned earlier on, we've not only got oversupply of paper gold. Okay, we not only have that, but we've also got manipulation by central banks. Now, central bank does manipulate the price of gold, but they don't actually just manipulate the price of gold when gold's prices are steadily increasing. When you see a steady rise in gold's prices, that's okay. But when you see a jump in gold's prices, a big jump up, that is when the central bankers would then try to manipulate the price, because they don't really bother about steady rise of price. It is when you've got huge jumps, then they come in, and that was what happened. Okay, you've got huge jumps, so then you've got the central bankers coming into the play. Okay, so this is important for us to understand that. Okay, and lastly, we've got this one here was just read today, if I'm not mistaken, one of the major headlines from the mainstream media, and it says here the US dollar is not the dead cat just yet, as many of the other major currencies look to be in worse shape. Now, dead cat, we've got a pattern called the dead cat bounce as well. Whether or not we have spotted a dead cat bounce pattern on the USD index or USD related pairs, I'm not sure about it, but I'll be able to share with you on the charts. Okay, so just as we got a bit of an idea of what's going on, a bit of charts, illustrations or images I've shared with you about gold's ratio, about gold's correlation, a couple of things, hints here and there about what's going on, I would like to then share with you about chart patterns. Now, this is how I trade. I do mix it up between chart patterns and fundamental factors, geopolitical factors, but this is what we're going to be talking about today. Now, you guys may have heard about price chart patterns, harmonic patterns, geometric patterns is something I've tweaked by combining just price patterns and harmonic patterns, and found some Fibonacci ratios to be quite interesting for my analysis. So chart patterns, as you guys know, you've got flag pattern, you've got wedge, we've got channels, double top, triple tops, double bottom, triple bottoms, triple tops. These are all very popular ones that you guys would know more about. And then you've got triangles and all that. So that would be under the category of chart patterns. Okay. Now harmonic pattern looks like this. You've got numbers onto the charts. You've got all these numbers are actually Fibonacci retracement and extension ratios and things like that. So for me personally, I don't really have a very good memory, so I don't really look into memorizing all these and have a bit of a memory image in my brain to actually trade following religiously all these angles, numbers, retracement ratios and things like that. So hence the reason I favor geometric patterns, and would like to share this with you. And I use the core foundation of the ABCD pattern. Okay, so the ABCD pattern very simply is what you see, and that is what it is, and you guys are probably very familiar with it. But I use this pattern as my base, the ABCD pattern. As you can see in green, that's your bullish type pattern. Usually in an ABCD type pattern, the area that I would be trading is somewhere between C to D. So I'll let the A to B and B to C be a formation that would then help me predict the C to D move, and that's the same for the bearish rate ABCD pattern, as you can see. Okay, now when you attach these lines, okay, you've got A, B, C, D, you attach the A to C, and then you just draw it on the outer side of it, B to D, you get sort of like a geometric type pattern, as you can see. Okay, so hence the reason I call it geometric pattern. I've got my own ratios that I've selected, but I would like to share with you on why I trade this way and a couple of things that would be different from the other patterns. Okay. Now, most importantly, as I've mentioned, you've got the ABCD pattern. Now, I'll share with you on a step-by-step way of looking into the pattern before we go on to the live chart. Before going on to the MT4 Orbex live chart, we'll just look into first underlying your plan on spotting the pattern. So step one, you would just look into a chart like that. It's probably best to zoom out. Okay, you can do this this pattern on any time frame. it's probably best to choose between the three of 1 hour, 4 hour, and the daily in order for you to get more data into it and just to give you a bit of a better big picture kind of formation of the ABCD. Okay, so here this is an analysis of August last year, just to give you an example. We've got a low right down there. Okay, and then we've got a bit of a corrective move from the high going downwards, and you would need this area here, the final area, to go up a little bit. Okay, so you've got a low, you've got a high, and another low, and this should give you a better picture in step 2. So you've got low to high, you attach that, and then a corrective move, and what you're predicting or making a forecast of would be this area here going upwards on how high, for example. This is a bullish type pattern. Okay, so you would need that area to just come up a little bit before you have that prediction. So it's almost no way that we could just enter right on the dot here as it actually move. Okay, we would need that to be marinated first, prices, and then it'll be easier for us. So step 3, you're drawing the first leg. That gives you an idea. So that's your A to B leg. Okay, then you've got your B to C leg right there, and then your C to D. Okay, now we're predicting a move there, and how did I actually get that C to D? That C to D in length, you could equal that length to A to B. So your AB length, okay, would be similar to C to D. I'll show you on how we can draw that onto the MT4 platform, just using your Orbex MT4 platform with your trend line, and how you make that move from AB to your CD. So that's how an ABCD pattern looks like. I mean, once you are sure with a trend, it will then be a good technique for you to apply on top of what you already have. Okay, it would be, I mean, if it is to accentuate or to make your existing techniques to be even sharper, then you can always experiment on that and feedback me on how that have actually worked with for you. So that's your AB equals CD leg right there, as you can see in terms of length. AB equals CD. Okay. And if we go on to step 7, now this is quite an essential table right here. I mean, if you've got your mobile handy with you, or your camera or device, that you could take a snapshot of this table. We will then use this table as an essential guide in drawing your Fibonacci and making your prediction. Now, with the ABCD pattern, just as a reminder, the C point is highly crucial. Okay, the C point. So once you pull your A to B, you would be pulling your Fibonacci twice. I'll show you all this onto your chart shortly. When you pull your A to B, you would then would like to see the C point, okay, of where the C point, where has price landed onto the C point. And just knowing that C point would give you a bit of an idea, a predictive projection of the D. So the BC projection here is actually pulling the B to C to find the D. Okay, so your first Fibonacci is the first step in the Fibonacci is to pull your A to B, and pulling A to B will give you your C point. Then you take that Fibonacci off, then you pull your B to C in order for you to look for that projection at D. Okay, so we'll show you all that very simply onto the chart, so don't worry, it'll be clearer. But I would like you to have this table. Take a snapshot. Of course, for those of you who've requested the PowerPoint presentation to be sent to you, I can do that, not a problem at all. But this is highly essential. These are ratios. I mean, in the first column itself, these are Fibonacci retracement ratios, and the second column there are the Fibonacci extension ratios. Okay, so you've got both Fibonacci retracement extension, but your Fibonacci retracement, you use it to decide on where the D could go. So you would need to look at where C point is first. Okay, so that's highly essential. Okay, There you go. I'll just skip this because we'll go straight into the chart now. Let me just exit that. Okay, let's go into a chart, and I would like to give you a bit of an example of how we pull the Fibonacci first in predicting the AB, in predicting the D by pulling the A to B, deciding where the C is and all that. But before that, just for those who are not really familiar with Fibonacci ratios or the Fibonacci tool, on your MT4 Orbex MT4 platform, as you can see here, both on the demo or the live account, right at the top here, just around here, you would see that little F with these horizontal dotted line. That's your Fibonacci tool. Okay, you would need to click on that. Okay, and just pull that Fibonacci tool like this anywhere on your chart, and once you've double clicked that, in order for you to insert the ratios that I have shown you on the table, you just need to double click until you see the three little dots right there, and once you've got that three little white dots, you right click onto that area there on your Fibonacci, and then you click on Fibonacci property. And once you click on Fibonacci property, just scroll down and look into the ratios that you already have. And here, for example, the Fibonacci retracement ratio starts with 38.2 right there. Of course, it's got 23.6, but I don't use that, so you can leave it there or ignore it, but look into 38.2, make sure you have the 38.2. But this has got two formats. You've got the level column and the description column. So you would need, if it's 38.2, you start off with the first column inserting 0.382, and then your description area is 38.2%. Okay, so let's see, we've got questions here. Please email handout. Yes, okay, boy, not a problem at all. I will do that. Okay, not a problem. If you could just provide your email here, or you can always go on to Orbex live chat, and you can always request that. Okay, and that will be sent to you by email. Okay, and provide your email so that we can do that. Not a problem. Okay, so let's get on to the Fibonacci area here. You would need to insert, as I've mentioned, the Fibonacci ratios, and once you click on add, you could insert new ones, new ratios in there. Okay, so let's do that. We have got, let's say, an example here. You've got A to B, B to C, and then C to D right there. Okay, now here you would need C to progress a little bit more, so let me just draw what I mean. Okay, so you've got your A to B right there, and simply draw your B to C here, and once you've double clicked that and move that upwards, then you've got your C to D that way. Okay, so that's your first way of predicting your D move right there. So you could draw a horizontal line right here, and that gives you the projection of where D could go to, and that is if you've not seen that price move as yet. Let's say this was sometime back before that happened. So this is the first sort of way. You just grab the A to B and then mirror that to C to D and have that projection there. Okay, so you've got your first way of predicting your D. The second way, of course, is with your Fibonacci. So what I meant by the first Fibonacci move is pulling it from A to B. Okay, once you pull that A to B, you will need to look into the C area. As you can see, C was right on the dot, I would say, on the 78.6 ratio. So 78.6 retracement based on the table that I have shared with you. Let's go back to the table right there. So when I've pulled my first Fibonacci from A to B, that gave me the C point at 78.6. As you can see, if it's 78.6, it matches with 1.272. So what you would need to do then is pull your Fibonacci for the second time. So you would then pull from B to C, because you pulled your A to B to look for your C, but in order for you to look for your D projection, you will need to pull the B to C. Okay, so once you have pulled the B to C, then you look for that 1.272, which is right there, and that is quite close really with your initial A to B move. So once you've marked that, let me just mark that properly. Once you have done that, then you've got A to B, B to C, and C to D drawn. So your AB equals CD, that's one, that's your first projection, your first sort of take profit area as well, okay? And then you've got your second take profit area, which was then drawn using the Fibonacci tool. Okay, so I hope that has been quite clear for you. Let me just answer some questions here. Okay, thank you, Levar. Brilliant. It's probably best to go on to the live chat in Orbex and provide your details there so that they could do it all at once, sending you the handout. Not a problem at all. Okay, so if you go on to orbex.com, it's very easy. You see the live chat there. Click on live chat and just mention that you would like to request for the handout and you've attended my webinar here via investing.com. Okay, and that would be best. All right. Thank you, guys. Okay, so we've got that one way there, and I've just given you that example, okay, on how we're doing that. Now, back to what we've talked about, goals, prizes, and what's been going on with the charts and instruments and things like that. I would like to share with you on what's going on with the USD index, and we'll just look into whether or not we've got some sort of pattern. Now, apart from the ABCD pattern, the ABCD pattern can actually be extended to a W or a M-like pattern. Okay, I'll just tell you what I mean by that. Now, when you've got your A to B, B to C like that, let's say ABCD pattern, and this is a bullish ABCD pattern. When you've got a longer extension of price falling downwards, that's your that's your W-like pattern, and a W-like pattern is usually a bullish. It's a bearish type pattern, even though you've got a bullish ABCD here. So that gives you a reversal around here, which indicates a possibility of prices to fall. Now, I don't really look into specific type of pattern, but the way I trade the W and M is quite close to the Gartley type pattern, but they are ratios that I use differently from what the other traders are using. So we may differ in that side of things. Okay, so it's the same for the ABCD going downwards. Now, if you've got A, B, C, D this way bearish, okay, and then you've got prices extending upwards, then you've got an M-like pattern, and that is a bullish type pattern. Ends here, that's your D area, so that would then signal an upward move. Okay, so that's your ABCD pattern being combined with a bigger move before then it would form, giving you an M or a W type formation. Okay, so a W is a bearish type pattern and M is a bullish type pattern. So there you go. We've got ABCD combined with the previous moves, a big previous move could give you an M or W like pattern. Now this one here is totally separate. This is a Z or a 5-0 pattern. You can actually type onto Google 5-0 like this, 5, okay, oops, 5-0 pattern, and you just type the word 5-0 pattern. You should be able to look for it, and it's another word nickname for it is the lazy Z pattern. So I would like to share with what I could see on the USD index and also gold very quickly on the on what I see in terms of patterns, so you get a bit of an idea on how to marry that with price movement for gold and what to expect as well. Okay. Okay. Now, thank you, Levar. Thank you very much. He's got a question here by Levar. May I ask how to get the vertical scale, showing the vertical scale as it is not mine. The vertical scale, are you talking about Fibonacci, Levar, or the vertical scale, you mean at the sites here, the prices? I'm not quite sure what you mean by the vertical scale. Could you just maybe elaborate that, Lever? Let me know what you mean. Okay, so meantime, oh, okay, we've got Lever coming back here. Okay, the site as the price. Ah, yes, that comes out automatically onto the MT4 platform, the vertical scale. You should see it, or maybe if you don't see it, if it is not the MT4 platform, I'm not sure the settings behind that. If it's not Orbex's MT4 platform, if it is Orbex MT4, you should see the price scale here. If you don't see it, it may actually be a chance of not having that totally zoomed in, you know, like if you click on that square, give me a second, let me show you. Yeah, I mean, to enlarge it, for example, maybe it got this, it got a line somewhere like this, so you want to move it and maybe increase the size so that it totally widens up following your screen size. Maybe that's a reason why you don't see it. Okay, that could be a reason. I'm not sure because it usually comes with the display, so there's no way of hiding the price here at this moment of time. So it could be your screen. Try that out, or see what happens. Okay. Okay. So let's get to this. Let's just go into that. Let me show you guys a bit more. Now, this is a lazy Z pattern, and a lazy Z pattern, this is a bullish lazy Z pattern, okay? So how I've drawn that pattern is I've taken it from here. I've not taken it all the way at the top, but I've taken it from here, mainly because of the Fibonacci credentials or Fibonacci requirement, because when I pull that one there, it touches very, very nicely on the dot at 224%. Okay, and when I pull the Fibonacci from this area here all the way down, I see that it's actually gone here at 1618, and that was quite a good number for me at that time. So hence the reason I've done that. But it has actually, it has gone quite successfully, because a Z-like pattern, let me show you guys, a Z-like pattern, if you got a pattern like this, okay, up and then down, that length there would equal that length. Okay, so that AB, and then you've got CD, and usually it would reach about 50% here, and then it goes upwards. Okay, so I'll just show you what I mean now. If you pull your Fibonacci, first you do your, sorry about that, first you do your AB, okay, equals CD, right? So that's roughly where it was expected to go, but didn't really reach that area. But the other criteria is for, let me take that off, for you to actually pull this B to C area and look for the 50%, and that's roughly where it could have landed and gone. But what happened was that it sort of it didn't really complete or make this pattern highly successful because it, you know, it was far away from either the 50% or this area here. So what that have signaled me is more room to the upside, because it didn't actually go downwards here to make that upward move. It went much earlier. It bounced up or bounced off really early. So that is an indication of more buying power or dominant buying strength by the buyers, okay, by the bulls. So hence the reason this is what's going on here. Now, I would like to share with you another thing about the US dollar, okay, and we'll look into the USD JPY here. And let's look into the what do you call that, the daily chart, because this would then give you an indication of the strength of the dollar, and that would correlate negatively with the strength of gold prices. Okay, this is another Z-like pattern that worked really well. As you can see, the ABCD right here equal that, and then it bounced off on the dot and went upwards from there. Okay, but this is not the pattern that I wish to share with you. I would like to erase that. I would like to share with you an inverse cup and handle pattern that has been shared by major banks as well. They have spotted that pattern too. I would like to share with you that inverse pattern and draw that out to give you an idea of what I'm talking about. So here we've got the inverse cup pattern here. Okay, now what usually happens is that this inverse cup handle pattern is a bearish pattern. Okay, it's not a bullish type pattern, it's a bearish type pattern because it's inversed, an upside down cup. Okay, so what usually happens is you've got it going upwards and then making that correction downwards. Okay, now it'll come and meet the mouth of the cup area, which is around there. The reason why we pick that is because we've got this what do you call it, accumulation area here, accumulation of price, and hence we've got a bit more volatile area right there. So that becomes the mouth area roughly. Okay, so what usually would happen is that mouth area there would then be broken by the price action, and usually upon breakout at some point it would then revisit that mouth area, and once it does it'll play a little bit about and then further to the downside. Now that is what theoretically happens with an inverse cup and handle pattern. Now it is on the way up, but how far up usually it goes in the left side of this handle area is usually at about 50% of this entire move. Okay, this move here, all right, from that distance from the top to the mouth area, it should be around about 50% area. Okay, give and take 50% at least for it to meet right there before it backs down. Now I see a slowdown of price at this moment of time. I see a correction, so that gives me a possibility of a downward sort of pressure for the USD versus the yen. But I don't see that with the USD index. What that means is that the USD index is favoring more room to the upside because it is actually doing much better compared to the 6 other currencies that it's compared with. So that is still giving us room to think of more USD strength on average. Okay, but for USD JPY specifically, we're talking about a probable fall of price based on the daily chart, as we can see, based on this inverse cup and handle pattern. Now if I use the Fibonacci to give you a little bit of an indication of where that has actually met, whether or not it's at 50%, all I do is I grab that right at the very top to the bottom area here. I'm not taking that because that's a sort of a spike by the candle or the wick of the candle, so I'll take it right around there. Okay, and I could see that it played around that 50. It just tried to go above the 50% ratio, but it didn't really pierce through and showed a lot of momentum to the upside. So it's making that correction, and that's what's happening now. So this is following through. Prices for USD yen on a daily chart is following through really nicely, following the inverse cup and handle pattern. So we just need to follow through that, and we need to go on to the 5 minutes, look for patterns that would then match up with what we could see on the daily chart. Okay, so before I zoom in, I'll just answer some question. Lever has got a question here, a very good one. Will these strategies work on any time frame or mainly on higher time frames? Is a very good question. Let me tell you this. The strategies here, especially with the ABCD or patterns, geometric pattern especially, they work really well with all time frames, including the 1 minute if you can catch it, 5 minutes of course onwards, and on any instruments. This was founded by myself with the geometric side of it, with stocks of course, with the DAX, with anything, as long as you can see the chart, but with candlestick chart gives you better information. So yes, it's applicable to any time frame, any instruments level. Okay, so this is basically it. We've got a bit of a now this cup and handle pattern I'm sharing with you is not a geometric pattern. Okay, it is a just chart pattern. Now I'll give you a bit of an of what it means to be geometric. Now if I've got a pattern like that, let's say A to B, okay, and then you've got B to C right there. So I would then draw the AB equals CD. To equalize that, that's called quadrilateral, when your A to B what do you call that, mirrors C to D, right? So take that. So you've got your ABCD, just your chart pattern. The base of the geometric pattern is your ABCD pattern. So if you've got your ABCD now, like this, the moment you attach your A to the D right there, that becomes a geometric pattern. Okay, that's what I mean by geometric. Now, the reason I do that is to find the centroid, the center area here. So let's say if I've got, this is just very quickly so that you guys get the idea. So we've got C right there, and I'm predicting the C to D, correct? So I've got AB equals CD as one of my predictions, okay, forecast. And then I pull my Fibonacci, look for my C point. Using the table I've sent you, you're able to predict, give a bit of a prediction on the D point. But the center point, center area here where price have actually met right there, that's my ideal entry area. Okay, that's why I've experimented that thousands of chart. It has worked very well for me. So I'm using that center point area, above that center point area for a buy, and below that center point for a sell. So that center point area is highly crucial for me to draw a horizontal line. I'll just give you an indication of what I mean. And when you get a horizontal line drawn right in the center right there, that's your entry area. And then your take profit area would be, if you're trading from C to D, your profit area would be just before you reach the D area. So we can always adjust the prices with psychological levels or any techniques you're familiar with to further reduce the risk and increase the probability. Okay, hope that gives you a bit of an indication of what geometric pattern really mean. Okay, so that's just a base, an idea for you. Now if we go on to, let's just go on to gold at the moment, and I'll give you an indication of what I've seen in terms of pattern. Now we go on to the daily chart. This is what's going on. Now here, very briefly, I would like to just give you an indication of gold's prices, and this is trading at the moment at 1189.29. As you can see, market's live at the moment. When we had this ABCD type pattern, I'll just get rid of all these ones here. Okay, this AB basically was meant to be equal there, but prices went through it. You see, it went all the way down. So that meant that it's got more power to the downside. So that hinted me that gold has got more power to the downside. Now, the thing is that we've got a bit of an ABCD going on here. If you guys can spot that, before I draw a straight line using the trend line, I would like to just draw that here. A to B, B to C, and then you've got more projection downwards, correct? So let's draw that ABCD here. Give me a second. All right, I'll just move that. Let me just delete that first. Give me a second, guys. All right. Let's use a straight line here. So I'll just go on like this. A to B, have that correction all the way up, but not that wick there, because that is not the peak. The peak is here. That's just a spike of a single candle coming out there. So I'm not taking that peak as my C point. C point's here. Okay, so I've got my B to C right there. Now we double click that A to B and move that right downwards here. So there you go. You could see that that was a very nice AB equals CD because it's on the dot. As you can see, it's right on the dot there where prices just bounce up a little bit from. Okay, so I'll just redraw that A to B line. So you've got your A to B right there. So let's say that we were selling gold and I intended to sell gold at the time that it was just falling after the C point here, and I would like to then know where should I actually have entered, where would I have entered previously. So I turned this ABCD pattern into a geometric pattern by attaching my A right down to the D right there. Okay, so then I draw the horizontal line right based on the center point, or the centroid as I call it, and I would then be trading on a short under the 1272.95 area below. Now if I just take that round number at 1272, then I would prefer to wait for prices to fall at 1270. Reason being the 1280 is a psychological level, so I would like about $10 less than the 80, making it 1270 as my ideal entry point, and I will then take profit above the 1170 area at 1175. Okay, so I have taken 1272 and 1170. So 1270 entry price, 1175 my exit or take profit price. Okay, that's just based on the Fibonacci, on the geometric pattern that I've just shown you guys. So this is where we're looking into a possibility as well of prices moving upwards, but if we pull the Fibonacci right from here all the way up there, we could see that there definitely is a chance for a bit of a bounce upwards. How high though, it's questionable, but because it's right on the dot of the 61.8% Fibonacci ratio, which is quite a significant one. Now here we have got support, we've got resistance here that have actually become support. So it's essential for us to draw some support resistance zone, not a single line, but the zone, in order for us to capture that zone as a potential support or resistance. Okay guys, so that's my take on the gold's position at the moment. We should not be overly excited of a price bounce just yet, but it's essential for us to trade in stages. So hence the reason it's essential for us to look into different time frames, look into whether or not we have got a bit of a chance to the upside. Like for example here we've got an A to B and then it corrected itself here C, so we're looking into a bit of an idea upwards. So if at all the trend is for us to the upside, then if we draw our first line of A to B, let's say from there, okay, A to B, and then we take that, double click that, move that all across there, okay, and then draw your original A to B line right there. Right, and if you've got your A to B and your C to D, okay, that's your first way of predicting it, and then you have got your D point right there, okay, and if at all you're looking into entering, let's say you want to get a bit of an ideal point, you turn that pattern into a geometric pattern. Let me just tidy up that a bit, and once you've done that, the center point area is an ideal area, and one thing special about the center point or centroid area is that it's automatically, usually most often than not, automatically a significant support resistance zone. As you can see how support concentrated there. If you look back as well, if you go on to higher time frames, get a better idea, you could see how prices have concentrated in that area almost automatically on its own. Okay, so hence a reason I like turning that into a geometric type pattern in order for us to get a bit of an idea. Okay, so here itself you've got an ABCD. If I take that attachment of A to D away, you just got your ABCD area predicting that. So we'll use Fibonacci now by pulling the A to B, okay, and look into the C. So C, you could say that it's quite close to the 50%. You know, you look at where the body and the closes are, it's closest to 50%. If it's based on the table I've provided you with, 50% will give you the 200 extension or projection by pulling your B to C and you look for your 200. So your 200 has indicated more room, potential to the upside right there. Okay, and that just mirrored right through there. So you've got a bit of a range of where prices could actually go to. Okay, if you've attached the bigger move right there all the way down, that gives you a W-like pattern, and you can always pull your A to B right there and look for the 61.8 as well as the 78.6 as your guidance of where selling could actually take place. 78.6 is quite a good one here. 61.8 is too far down there, which is too close. So you give it a bit of an indication at 78.6 as the potential sort of turnaround area. You can always pull X to A and X to C, X, A, B, C, X to C as well. And again, look for the 78.6 area as quite a high probability sort of area. So you've got now a zone of where prices could turn. So it's most important at this moment of time to look into prices going past or piercing through these Fibonacci, this moving average line. So once it's above the moving averages, you've got a clearer way for it to go upwards to find that there. Now 1189.01 is probably best to wait till you go above the 00 by at least 10 pips or so. So 1189 point, this is gold, sorry, so we're talking about cents and dollars here. So 1189.10, like as of now, but it's probably best to look into prices of the candle going above at least this 100 moving average first, and then looking into buying opportunity. But you've got the reversal zone marked here as well. Okay, and this reversal zone that we've marked here based on the W-like pattern, coincidentally it meets, it's got the 200 moving average right there as well. So that does coincide with making that zone quite a probable reversal zone if at all gold has gone above the moving average here and heading towards this area here. Okay, so that's your shortest term 30 minutes chart that we're looking at now, okay, for gold. And if we're looking into the 1 hour chart, looking at that and zooming in, we're again would be looking into more challenges or obstacles faced by the prices of gold, because we have got the moving averages there. It would need to cross through or pierce through all three moving averages to give you a clearing sign of bullishness to the upside. Okay, but at this moment of time, as you can see, we could easily draw a bit of a resistance zone right there based on concentration of candles there. So if I based on that body and that wick right there of that candle, you can see that that's where prices for gold on the 1 hour chart needs to pierce through first to give us indication of bigger upward move. But at this moment of time, it looks like it favors the downside as opposed to the upside. So hence the reason it's confirming, coinciding with what we've actually seen in the strength of the dollar. We've got more room for the dollar based on the USD index as well, and now we've got more a bit more room to match with for gold to the downside. Okay, guys, so that's basically it, just to give you a bit of an idea of what gold is doing from both fundamentals, technical, as well as the geometric pattern side of things. I hope that has been interesting for you guys, and if you guys have got any questions, I would like to open this session for questions at this moment of time. Any questions at all, guys, about the techniques, about gold in general, or anything you guys would like to share with me? Any questions at all? Yes, we've got questions coming through. That's very good. Okay. All right, Lever, thank you for that. Good. Are you guys familiar with techniques like this or not? Ken has got a very nice question here. How long do you wait for the C turn up before you project the D? That's a very good question. Now, the thing is that I trade a lot with using psychological numbers, okay? So how long would be more price sensitive for me? I'll give you a bit of an indication. Let me just go on to the Euro USD to give you a bit of an idea of what I'm talking about, okay? So here, for example, you have got, I usually look at the last two digits of the price as well. Now, if you've got A, B, C, D, it does depend on which time frame, okay? Now, 4 hour, of course, giving you more chances of ABCD patterns and formations and all that. But let me just draw and tell you what I mean. If you've got an A to B and then B to C like that, and then your question is how far this should go. Now, in theory, it's best for it to go at least 50% of that. Okay, that would be a good indication. So 50% of B to C. Okay, at least about 50%. All right, and once it goes above that 50% just a little bit, you could then start to pull your Fibonacci and do that. But when you want to talk about a geometric pattern, the thing is that when you would enter would actually be much more of a question. You know why? Because your entry point depend on that centroid that I've mentioned earlier on. So when you have that centroid, when prices have not touched that centroid, you wouldn't actually be entering anyway. Okay, so how far would be a better question for me to, a better answer I would provide you with is wait till price gone slightly above the centroid area, and then you adjust it to the psychological number that I'm going to talk to you about. Okay, so based on the centroid is number one rule. Secondly, based on psychological numbers. Now we have got 4 sets of psychological numbers that I use. I know other experts may have used or using different types of psychological number, and this is all based on the last 2 digits of the price. So now I'll give you an example. Euro USD 1 hour chart right now, it's trading at 1.06, okay, 42, okay, 42. We're just paying attention. If it's 5 decimals, we need to turn that into a 4 decimal point. Then you look into the last 2 digits here, okay. There are 4 sets of psychological numbers that I look at, which are 00, okay, right, and then 50. It's in no order actually, okay. So just remember these 4 sets of psychological number based on the last 2 digits. So you go 00, 50, 20, okay, and the last one is 80. These are the only 4 that I pay attention to, okay, and I adjust my take profit point, my entry point based on this. Now this is how you do it. Whenever you look into the current price like now, and you want to ask yourself whether or not you should be buying or selling or setting up your stop loss and take profit, is based on price action. And how do you do that? Is this: when you've got the last 2 digits of the price, let's say now it's 1.0642, the last 42, the last 2 digits is 42, you need to ask yourself, the 42, which psychological level is it closest to? Because the 42, because we're looking into prices going up, right? We're buying, let's say. So you're looking at prices going up. Now 42 will go to 43, 45, and so on and so forth. So 42 going upwards, which psychological level is it closest to? So I think some of you guys are answering the question. So Go will perform this file, Stefan. Stefan, we will look into that definitely. It looks like it's got more bias to the downside because based on patterns as well, if you apply your exponential moving average 50, 100 and 200, you will find that across most of the time frames for gold, it is under the 3 lines, or it's just playing in between the 3 lines. It's not going above all the 3 exponential moving average. So what that means is giving me more hints to the downside as opposed to the upside. Okay, so hope that answers your question, Stefan. And now back to the psychological level. If you want to buy, you need to buy at least 10 pips above the 00, 10 pips above the 50, or 10 pips above the 20 or the 80. So now here 52 is closest to 50. Okay, so what you do is that you need to add 10 pips above the psychological level, so that would give me 60. So my ideal entry price should have been adjusted, and it would be 0,660. Okay, why? Because you got prices turning points mostly within 10 pips of the psychological level. Let me prove that to you. Let me just clear all that up. All right, look at this big move here. Okay, you've got prices all the way up and then bang down. Look into the body, the highest body that it has closed at, and the highest wick that it has actually made that peak at as well. Look at this, 1.0685. 85 is about 5 pips away from 80, and 80 is one of the psychological levels. And then you've got this one here, 1.0663 is not really too much, closer to the 50, but not within that 10 pips. So look at that peak, either one, either the peak or the body closing body there, make a zone and look at both prices. So hence the reason we want to always get out at least 10 pips before the psychological level as well. So to answer your question as well earlier on about where do you enter with the ABCD, you know, how far would the C go to, you would like to base on the centroid area, number one. Number two, you adjust with the psychological levels. Okay, now this big level here, for example, you have got highest body right there, 107.34. Let's say we follow this one here, 107.36. And what about the wick area right there, 107.44. So that 44 is about 6 pips away from 50. So either one, closing price or wick price, when it reverses, it's usually within 10 pips of either one of the psychological sets that I've actually given you. Okay, all right, so any more questions, guys, before I wrap up this session with you guys? Any other questions at all? Has that been clear for you about the questions about where you would like to enter as well with the C point on the geometric pattern, or the ABCD pattern turned into a geometric pattern? Okay, you guys are all right? Okay, we've got questions coming through. Let's see. Okay, brilliant. That's clear. Fantastic. And hope, Stefan, as well, for your gold. I mean, I can't say that 100%, but it looks like the biasness is more towards the downside for gold, still more room to the downside and more room to the upside for the dollar. So what you can then do is experiment it with your ABCD pattern and then turn that into a geometric pattern. Look at that cross, that centroid area is your ideal entry. But first and foremost, a little tip for you guys is best to look into time frames in a cluster of 3 time frames. For example, 1 hour, 4 hour, and the daily chart, and then look at whether or not you've got the trend dominating and matching in all 3 time frames. If it does, then it gives you that trend to be strong. Okay, so strong trend is probably best to look for your patterns, whether it's geometric or the ABCD, in a strong trend type environment. Okay, all right. Okay, where is the best place to put the stop loss? Ashish, that's your question. That's a very good question on the ABCD pattern. Okay, this is what I do. I trade the ABCD pattern and I make sure that I'm, you know, I've got good trend, what do you call that, hints. The hints of the trend needs to be strong. You need to have good grasp of the trend compared to 3 time frame. And once that is done, what you do is you look into that C point as well. The C point, if it lends 61.8 and 78.6, for example, either one of that gives you higher probability and lower risk. If you've got that, then what you could do is use that simple 1 to 1 risk reward ratio. So meaning you want to look into your entry point right up to your D point, how many in pips, then you mirror that exactly from your entry point to your stop area. So if my entry point to my take profit is 50 pips, then I put that 50 pips for the loss. 50 pips would be equally my willingness to take that loss at. Okay, hope that's clear, Ashish. I just used a 1-to-1 ratio. All right, that does actually depend how much you're lowering your risk by using that Fibonacci ratio as well. So 61.8, 78.6 are considered the higher probability, lower risk type Fibonacci ratios. Okay, good. Okay, guys, I think how has the win ratio been with this strategy? Win ratio, it does actually depend a lot on the time frame. The 4-hour time frame, 1 hour and above time frame does actually work much better. We could look into a 75 to 80+% type ratio, but this has to be matched with your strong grasp of trend at the time. Okay, so I write the trend, I find bullish pattern in a bullish trend, bearish type ABCD or pattern in a bearish trend. Now, if you are clear in that side of it and your Fibonacci ratio is actually quite clear, then you can look into 80% sort of on average. Okay, so out of 10 trades, 7 to 8 wins or 2 to 3 sort of losses. So this is basically on average, but it's best to leave that performance sort of ratio to you guys as well and feedback me via Orbex and let me know how has it been with your ratio in terms of performance, because it needs quite a number of things to checklist in order for this sort of technique to marinate well, to be amalgamated into that trade planned very well. Okay, so this is basically it. All right, guys, hope that has been enjoyable, interesting for you guys. So I would like to then wrap this up, session up. And for any other questions, guys, get in touch with Orbex live chat, and you'll be able to reach me through Orbex, okay? And they'll pass on information to me, messages, and I'll get back to you guys. So do provide your email and things like that to orbex.com live chat, and we'll be able to get in touch. Okay, guys, thank you very much, Ashish. Have a very good evening, guys. Once again, I would say a big thank you to you guys for attending today's webinar. Hope you guys enjoyed it, and thank you very much. Have a good evening. Bye-bye.